All right, so we spoke about what balance advantage funds are and who is this beneficial to, but the other important aspect, that we need to kind of understand is that when you go ahead and invest in a mutual fund, everybody talks about returns. What is the correct way to kind of calculate this return is the real question. What is the difference between an absolute return, CAGR return, XIRR, etc. is something that everybody should understand. And to take this conversation ahead to understand exactly this, we're now joined by Prableen Bajpayee, who is the founder of FinFix Research and Analytics, joining us now. Prableen, thank you so much for taking out the time. I'll just, start by asking, as to what is the difference, firstly, between an absolute return and a CAGR return, and then we can dig deeper.
Hi, Mahima. Great to be here. Absolute return is the point-to-point return. So it has a starting date and an ending date, and the two dates can be 2 days apart, they can be 2 months apart, 2 years apart, or 20 years apart. So it takes into account one value and the next value, which is your final value. And the simple formula is that you subtract the ending value. You have the ending value, you subtract the initial value from it and divide it by the initial value. That's basically absolute return. A simple example would be, let's say I have an investment of 50 lakhs and it becomes 1 crore. So it's doubled, and the absolute return here would become 100%. If I have to give an example, Mahima, related to the markets, let's take the Nifty 50 index. It has given us absolute returns of roughly 219% in the last 10 years. But broadly, when we're talking about absolute returns, we are totally ignoring the time factor. So while absolute returns is a good measure to know how an investment has done, and you can even do comparisons of two different investments, the time element is ignored. And within mutual funds, absolute returns are used for any investment comparison for less than 1 year, Mahima. Now coming to CAGR, which is the compounded annual growth rate. This is where we introduce the time element. And if we have to define the compounded annual growth rate, we can define it by an average annual return that an investor would earn over a specific period of time. So let's take a previous example where the 50 lakh became 1 crore and our absolute return was 100%. Now, when we insert time here, and let me give you an example with 3 different time periods. Let's say it's 7 years. With 7 years, the same investment CAGR will turn out to be 10.4%. If the time period is 10 years, the CAGR, or the CAGR, what we call, will only be 7.18%. And let's say if this investment has doubled in 15 years, then the CAGR drops to 4.73%. So, Mahima, the very important thing here is that the longer it takes to double, the compounding process shows you that the returns, the compounded returns, are lower. So when we're looking at mutual funds, the same example, let's say Nifty, giving us the 219% returns in the last 10 years. If we are looking at the CAGR or the CAGR, then the CAGR works out to be roughly 12.26. So these are 2 very important ways of looking at mutual fund return investments. And when we're looking at more than 1 year, for a lump sum investment, then definitely CAGR is what we're supposed to see. And even while making comparisons, but just, one more point here, Mahima, that often when we're talking about investments other than mutual funds, especially real estate, we often just look at the absolute returns, that the properties become 4 times, 5 times, it's given 200% returns. We often do not calculate the CAGR for any other investments other than mutual funds and financial instruments, basically.
Understood. Probably the other aspect is that, people often do not understand the importance of XIRR, right? The difference, of course, we'll try to understand later. But first, I think it's important to understand the meaning itself. If you can help us, help us and our viewers understand as to what XIRR means and what is the importance of this metric.
XIRR is very, very important, Mahima, especially as an SIP investor. And even for a lump sum investor, let's say you've made investments at one point and then you added something and then say you withdrew at one point. So whenever there is some sort of a movement in between your investment period in terms of an inflow and outflow, then we have to look at XIRR, which is also called the extended internal rate of return. And XIRR becomes a true measure of that movement and the overall return. This is because let's take an example of an SIP. Let's say I do an SIP for 10 years. So I have to do 120 installments, and the time period that I'm allowing my first installment is actually 10 years. But the time period that I'm going to allow to the investment that I did, let's say in the fifth year, seventh year, 10th year, in the ninth year would be so different. So the time they get for compounding to grow is much lesser, but XIRR takes into account all of this. It is also possible that you make a lump sum investment in between or you withdraw some money. So the formula for XIRR will take into account all of these factors and the different periodicities, and based on that it calculates the compounded growth, but for different periods. So it's almost like a representation. It's a variation, let's say, of a compounded return, but it definitely looks into the different periods that have they have been considered for this return. And that is why XIRR for an SIP investor, I think, is the right measure. And obviously, whenever we are looking at our own returns, then also XIRR is actually the true measure of how your investments have done.
Okay, got it. So now, when we talk about choosing a mutual fund based on the returns, right? We've talked about absolute returns, we've talked about CAGR returns, we've talked about what XIRR means. When somebody is looking at a mutual fund purely from the perspective of past returns, how should one look at them? What is the analysis that one should keep in mind, and what are the metrics that are of the utmost important from everything that we discussed, plus anything that you would want to add?
Right. So, Mahima, first of all, that past returns can be very, very helpful. At the same time, they can be a little misleading as well. And also, they can bring in make an investment look very, very enticing and great. At the same time, they can also make an investment look really dud. So, for example, if you're looking at the past 2 years, gold has given roughly 100% return in the last 2 years. And if you're looking at Nifty 50, it's barely about a 4% return. So whenever we are looking at gauging how an investment has done, I think it's important to take a holistic view. And a holistic view would require you to look at the different returns. So let me give you an example here. Let's say March of 2020, somebody invested, and till today, their CAGR for a lump sum investment in Nifty 50 would roughly be 20%. On the other hand, if it was an SIP investment, the returns would only be 10%. So, Mahima, it's important when we're looking at the past performance, you look at different measures. So you look at the CAGR, you look at XIRR, and you can also look at the absolute return, and then have a comparison with what the peers have done, what the benchmark has done, to get a fair idea. But also when we're looking at the past, don't look at the perfect periods of investing. Like, March 2020, somebody investing is almost like you got the dip. But that's not going to happen. So whenever you're looking at the past returns, you must look at different time periods, the good and the bad phases of the market. And other than that, Mahima, one also has to look at, what is the risk factor, how much volatility, downside risk has been there. So there are different measures like the risk-adjusted returns, consistency throughout the returns. And finally, I think, on top of all of these, six rolling returns, probably, which is a conversation for another day, but I think rolling returns are also really, really important when you're looking at your overall investments and looking to invest there.
Got it. Praveen, like you rightly mentioned, right, XIRR is more relevant for SIP investors. Now, if somebody wants to easily calculate this, what are the ways and means available to calculate the same? I am sure that there would be calculators available online, or if you can suggest a better way.
So yeah, most mutual fund platforms and apps or portfolio trackers, Mahima, would have an inbuilt system of checking the XIRR. But if somebody is keen and you're looking at doing it on the Excel or your Google Sheets, it's possible. So you have all the time periods added to one side, and then you have the investments added as well, and the withdrawals done. So investments done would come in negative and the withdrawals would come in positive. That's what the formula would suggest. And then it's a simple, equal to XIRR, and the values and the dates are added together and you can get the returns actually. So it's fairly simple, but I think it would be automated for most people because we all are using some platform or the other or an app. The problem, Amaima, lies that whenever you're doing this, be it your CAGR or your XIRR, none of these returns shows the volatility which took place. You know, an XIRR of, let's say, 15% or a CAGR of 20% looks really great, but it does not tell you that there was volatility during this time period. For example, an CAGR would probably, you know, if it's, let's say, 20% or 15%, one would feel that that is the return that I'm going to get every year. And the real story is very different, because it may be plus 15 one year, -8, -7, plus 10, -5, and so on. So I think it's very important, whatever be the measure of calculating, you have to understand that with the equity, you know, any past returns that you're checking should not be a quick way to look at or jump into conclusions as well. And for investors who are currently investing, I'm sure the XIRR as well as CAGR looks poor if the investments are done in the past 2 or 3 years. So I think just stay put there.
Okay, all right, Prableen, thank you so much for helping us understand this concept so easily. I'm sure our viewers now know how to calculate their SIP and mutual fund returns in the right and perfect way. But with that, viewers, completely out of time on this edition of Your Money Matters. But do stay tuned for more news and updates on the other side.